Welcome to The Explainer. Today, we're putting on our investment analyst hats and diving into a massive, kind of mind-boggling strategic divergence between the two most dominant digital toll roads on Earth. We're talking, of course, about Visa and Mastercard. Now, for decades, these two have moved in absolute lockstep, right? Just printing money by facilitating global commerce. But as we look ahead to 2026, something genuinely fascinating has happened to their valuations. So let's jump right into this massive curiosity hook. Visa and Mastercard share an identical architecture. I mean, they literally don't lend money. They just operate the network rails and collect a tiny fee every single time a transaction crosses them. It's brilliant. Yet the market is treating them completely differently right now. The big question is, why on earth is the market willing to pay a massive 38-point premium for the smaller twin? It just doesn't seem to make sense. To figure this out, here's our game plan. First, we'll look at the free surfer framework. Then, we'll break down that 38-point spread, examine the leverage mirage, and check out the regulatory sieges, along with that famous Berkshire exit. Finally, we'll look at how they're orchestrating the future of commerce before delivering our final verdict.
All right, part one, the free surfer framework, which is honestly one of the rarest business architectures on Earth. To really get the numbers we're about to crunch, we first have to understand the sheer genius of their shared business model. Analysts like to call this the free surfer model. Think about it. In most businesses, growth costs money, right? You got to build new factories, hire more staff, the whole shebang. But both Visa and Mastercard fuse together a short-duration cash toll, which is that little fee on every single swipe, with a long-duration structural wave. And that wave is the massive global migration from cash to digital payments. The result? They're growing their revenue without really growing their costs. The cost of their growth is, practically speaking, near zero. It's geometric compounding at its finest.
And the institutional metrics absolutely back this up. They confirm we're essentially looking at the exact same business twice. Let's look at this through Warren Buffett's lens for a second. He loves an incredible economic moat, and both of these companies definitely have it. They're converting around 50% of every single dollar of revenue directly into free cash flow. Plus, they're operating at margins well over 60%, generating absolutely massive return on equity. They are identical, pristine engines of compounding wealth. Moving on to part two, the 38-point spread and that glaring valuation gap. Now, if we run a discounted cash flow, or DCF, model to find their zero growth floor, meaning what is the absolute minimum this business is worth based purely on current free cash flow, assuming literally zero future growth, well, Visa, sitting at $326, is actually trading at a deep 21% discount to that floor. Meanwhile, Mastercard, at $492, is trading at a 17% premium above its floor. So you've got this wild scenario where you can grab Visa at a massive discount to its minimum value, but you have to pay a hefty premium for Mastercard.
Which brings us to part three, the leverage mirage and the strategic divergence.
So why the gap? Well, the first big reason is what we call the leverage mirage. See, Mastercard operates with a massive 74% debt-to-capital ratio. They are heavily borrowing money to aggressively buy back their own stock. And what that does is artificially inflate their earnings per share, making their growth look a lot faster than it actually is organically. Visa, on the other hand, operates at just a 35% debt-to-capital ratio. If we apply Peter Lynch's classic balance sheet test here, Visa passes with flying colors. They are self-funding their stock buybacks straight from clean, operating cash flow. Mastercard's massive debt load actually compresses its valuation floor and introduces a kind of fragility that Visa's fortress-like balance sheet completely avoids. Beyond the balance sheet, their actual day-to-day strategies have started to diverge too. Visa's going all in on massive, overwhelming scale and ubiquity. I mean, we're talking about processing an unbelievable $16 trillion in annual volume across over 300 billion transactions. It's staggering. Mastercard is a bit smaller, but they focused heavily on extracting premium value, really leaning into cross-border travel and affluent credit card tiers to capture a slightly higher yield on each transaction. Right now, the market is rewarding Mastercard's higher yield growth narrative, even though, as we just saw, it's heavily fueled by debt.
All right, let's hit part four, regulatory sieges and the famous Berkshire exit.
The second big reason for Visa's discount is that they aren't just battling Mastercard anymore, they're fighting an all-out war on rails. They're facing down government-backed real-time payment systems like FedNow, which allow for account-to-account transfers that can basically bypass card networks entirely. Add to that the pending Credit Card Competition Act, an interchange settlement slated for late 2026, and a massive Department of Justice antitrust trial looming in 2027, so you can see why investors are a little spooked. There's a perceived regulatory ceiling hanging over the larger twin.
And hey, we've got to address the elephant in the room here. Warren Buffett's Berkshire Hathaway recently sold off every single share of Visa and Mastercard. Naturally, that made headlines. But guys, it wasn't a fundamental bust for the underlying businesses. It was actually just routine portfolio management. Todd Combs, the manager who originally championed these stocks, left for JP Morgan. So Greg Abel took the reins and simply cleared out the old manager's book. The actual business metrics for Visa as an economic engine remain incredibly strong.
Let's shift gears to part 5, orchestrating the future of commerce.
So how is Visa actually fighting back against all this regulatory pressure? Well, they're actively shifting from just processing transactions to literally orchestrating commerce itself. They are heavily pushing into value-added services. We're talking fraud protection, deep data analytics, and consulting. This segment now makes up nearly a third of their total revenue, and it is growing at a massive 27% clip. What they're doing is building incredibly deep switching costs, making it a total headache for banks and merchants to ever leave their ecosystem.
This defense strategy builds a spectacularly powerful moat. Visa is essentially using its $16 trillion network as a Trojan horse. They're integrating with OpenAI to seamlessly handle payments inside new AI agent ecosystems. They're already processing $7 billion in annualized stablecoin settlements. They've issued well over 10 billion secure tokens to slash fraud rates, and they're buying up cloud-native infrastructure platforms like Pismo. They're not just a toll booth anymore. They're selling indispensable, super sticky tech services to ensure they survive and thrive no matter how the payments landscape evolves.
Finally, we arrive at part 6, the final verdict, the gap, the gift, and the guarantee.
As we synthesize all these models we've talked about today, from the free surfer architecture to the DCF floors and those looming regulatory threats, we have to ask, as an analyst, what are you actually getting at today's market prices? This brings us perfectly to Benjamin Graham's classic defensive investor checklist and his famous concept of the margin of safety. At $326, Visa offers exactly that. You get a deep 21% gap below its intrinsic floor, plus about 10% clean organic growth, and a near certain convergence over time. Mastercard, on the flip side, relies so heavily on debt. To justify its current price of $492, Mastercard would basically have to sustain a 13% growth rate for the next 20 years just for you to break even on the premium you're paying right now. Simply put, Visa right now is the patient value investor's dream.
So, I'm going to leave you with the somewhat provocative thought to weigh as you consider your own investment strategy. When you are looking at two practically identical engines of global commerce, are you going to chase the heavily leveraged premium, or will you patiently collect the deep discounted gap? Thank you so much for joining this deep dive explainer. Catch you next time.